Hi everyone, I just want a big welcome to Scott Phillips from the Motley Fool. G'day Scott, how you doing?
Mate, g'day. I'm very well, mate. Enjoying isolation in a way that I probably shouldn't be. I'm an introvert by nature, mate, so I'm not struggling too badly being stuck at home, but we're getting through it. I mean, obviously more important is the health stuff, and also pretty cool to see that the curve is flattening, which is kind of good. So, mate, it's not a great time, but as an eternal optimist, happy to see things getting better.
Yeah. You said you're an introvert, Scott. I struggle to believe that.
You honestly, my wife is driven regularly nuts by my introversion. She's an extrovert and a pretty big extrovert. I'm happy at home with a couple of good mates. Yeah. That's about it. So the longer I'm stuck at home, the happier I tend to be.
Well, you've got a big smile on your face, so that's good.
Exactly.
Good. Well, no, I mean, look, it's amazing to have you on. Like, obviously, we've been working, with the Motley Fool. There's been no official relationship, but it's just been a lot of our customers are your customers and vice versa. So it's going to be really good to find out like what you and the Motley Fool have been doing. But I actually want to dig a little bit further back and get a little bit of your history. I think it'll be really interesting for everyone out there.
Yeah, fair enough. Look, I mean, I've come out of industry. I left uni and worked in a whole lot of FMCG companies, so fast-moving consumer goods. I worked for Heinz. I worked for a company that used to import Dill Martine, Lavazza coffee. I worked for Diageo, the big alcohol business, for Blackmores. So I've kind of had a 20th Century Fox. I had a really deep and long FMCG background. And at the same time, I'll give you the quick version, but 1998, I grabbed the Sydney Morning Herald. And there was a thing about investing, and some US investing sites mentioned some strange site called the Motley Fool.
Oh, wow.
And so I'm working at Heinz at the time. I open the paper, read this article, jump online, fool.com, whatever that is, strange name, but whatever. and that started I've been a customer of the Fool now since then, so that's going on 22 odd years.
Yeah.
Not quite. And so that's kind of the genesis. Now, I kept working in FMCG in industry for another 10 years. And strangely enough, 2010, late 2010, I saw an article in one of the Facebook posts, I should say, by the Motley Fool CEO saying, well, the next step for the Motley Fool is international expansion. This is when it was only in the US and in the UK. I sent an email on spec to the CEO and said, hey, look, I love what I'm doing. I'm really good at my job. I like my job, and I'm not going anywhere. But if I can help it anyway, if you come to Australia at any point, let me know. So I did that. And strangely enough, about 3 or 4 days later, I got an email from my now boss, Bruce Jackson, who said, funny you should say that. We're just setting up an Australian business. Let's chat.
Yeah.
So complete sliding doors moment. And so I freelanced with the Fool as a writer for about a year, and then joined as a full-time Fool in February 2012, and have been running Share Advisors since April 2012, and I've been the CIO now for about a year and a half after a short stint as general manager, and before that as director of research. So coming up to 10 years of being a permanent employed Fool, been a fan of the company and a customer for much longer.
That's amazing. And so was that your first dip into investing, or were you investing before 98?
So as a retail investor, I've been investing since 96, I think. And so that hence the interest. I had a terrible early investment career.
Even during the tech boom?
I made all the mistakes. Sorry, mate?
Even during the tech boom, you could have put up a website and been a billionaire back then.
Exactly, and they lost it all. So that was literally the experience, right? I owned sausage software, for those who remember that. Yeah. I tried my hand. I had a boss at one point who said, all you do is you buy, remember MIM mounts, I was at mining? You buy MIM when the shares are up, and then when they go down, you sell them, and you got this sort of buying, selling, ride the wave, ride the cycle. So I tried that for a while. That went badly. I bought Computer Share and then sold them like $2 or something, which is in hindsight,
What are they now? They would be
mistake.
I mean, I haven't looked in a while, but they'd be multiples of that, right?
$12, $15, I think, plus dividends through the period. So yeah, I mean, it's all that story. So that was kind of I dabbled around. I had a brokerage account. Through school, I was really like an economics teacher who opened our collective eyes to investing in the power of that.
Yeah.
We got the share tables out of the SMH back in the day when that's all you could do. You had to get the paper or the fin review, and you'd open the page and run your finger down the line of the dividend yields and the PEs.
I can work out how old you are now.
I can't hide from that.
But only I can do that. There's going to be a lot of people who have no idea what we're talking about. So it's all right.
Just trust me, there was a thing called newspapers once, guys.
They were black and white, and they were actually a lot bigger than they are now.
Ink on your fingers, yeah, exactly.
So you went into that, and then 98 you started with the Fool, like reading it, and then you were still working through that period. how, were you using a lot of their research, or were you sort of self-directed and just picking a little bit of what they're saying and then digging into companies? Like, what was the strategy from then on?
Mate, so I've had investing's a funny thing, and everyone comes through it differently. I was just messing around doing God knows what for a couple of years. Didn't really know what I was doing, but knew I should invest, knew it was powerful, knew it was worth doing, but didn't really know what I was doing. That's why I kind of got sucked into the fool really early on.
Yeah.
Some of the great fool investors from the US, I just started reading religiously, literally daily, weekly, just absorbing as much as I possibly could. So that was really the first of my kind of trying to codify what I thought I was supposed to be doing, what investing actually was. And then you usually discover the Buffetts, the Lynches, the Fishers. That was super useful. And then I think a lot of people, particularly who end up in investing as a career, kind of start as deep value investors. So I had spreadsheets literally manually typed in, because again, this is most of the tools we take for granted. I called the companies, got 5 years worth of annual reports sent to me.
Amazing.
And I would type up the P&L, the balance sheet, the cash flow statement from scratch. And then I'd do my little formulas to work out interest coverage and inventory turnover. And
amazing.
I had 40, 50, 60 different ratios. Well, here's the problem, right? I did that, which I thought was really clever. And then I realized that I knew all the answers, but not what any of it meant. So it's the old line about the price of everything and the value of nothing. Yeah. That was exactly me, right? I could calculate all these numbers, and then I sort of, right, exactly. Yeah. And so that was, it's an evolution, it really is. But coming out of that, I think that it's such a cliche, but the Warren Buffett stuff was just absolutely eye-opening. Reading the essays of Warren Buffett, the kind of abridged, the collated, volume of all of Buffett's letters from 1977 or something onwards, was just incredibly, incredibly eye-opening and meaningful, because it just puts the stuff. You need a framework, you need a mental model, and that for me was the first time I really had a really strong version of not just what are the formulas and how you calculate them, but how to think about business models, about competitive advantage, about the power of brands, about the power of growth, and where growth and value kind of met. So that was my kind of journey, if you like. And from 98 through to when I started at the Fool in kind of 2010, it was a really great apprenticeship of just kind of learning and growing as an investor and kind of doing that. And again, to take on the Buffett line, I was really, really lucky because, Buffett says I'm a better businessman because I'm an investor, and a better investor because I'm a businessman. Yeah. And it really genuinely was that experience of, I worked in the industry, I worked in what they call commercial management roles. So it's kind of one of those titles that's a bit FMCG specific, but I was basically the finance guy for the sales and marketing teams. Okay. So I wasn't that good of an accountant, and I wasn't doing the selling and marketing, but I was in that space where the pricing, the promotions, the profitability, the volumes, all the stuff that kind of makes businesses tick, that really makes a difference. I was right in the middle of that. So it was just a completely, very, very, very great fortunate training combination of education on the investing side and experience on the business side, which kind of put me in a really good spot.
Great. Yeah. So, I mean, what's interesting, I've read the Fall as well, like you've got a mix between some, like Buffett sort of value investing, and then you've also got sort of those growth sort of opportunities as well. And where do you sort of sit? Are you a bit of both, or you looking, you're sticking to one?
Yeah, because I've had the full experience, I tend to fish all over the place. What I will say is I think I don't love the difference between growth and value. I think, to be honest, people, they kind of retreat to one camp or the other, and it ends up being this kind of my team, your team problem, which God knows we've got problems with politics and everything else at the moment with that sort of stuff. The growth investors like to throw stones at Buffett. The value investors like to throw stones at the growth guys. Buffett himself has evolved massively. Ben Graham, his mentor, was all about, book value, net kind of, buying 70 cent dollars. Now, that's still Buffett's approach, but he doesn't just buy fixed assets for 70 cents on the dollar. He's buying future cash flows at 70 cents on the dollar. And so he says himself, his style is part Graham, part Fisher. This is Phil Fisher. Yeah. He's becoming the See's Candies story, the Coca-Cola stories. These are not stories of, deep value stocks. Yeah. That they are stories of quality brands and businesses that have, great pricing power, growth potential. So I probably in a quality growth is where I probably peak myself, forced to do it. So I'm not the higher risk early stage investor, nor am I particularly interested in everyone's old faithfuls that are going to grow at 3% a year. Yeah. It's trying to find quality businesses that have really good growth potential ahead of them. And if I've made mistakes in my career as an investor, it's largely been not putting enough on the growth, putting too much on the quality. So I made a shocking decision to buy Coca-Cola Amatil back in the day because it was a wonderful bit, like really high quality business. Yeah. Love it to bits. Love the product. Fantastic business. there wasn't enough growth left. It colonised Australia quite literally to the point where was the growth going to come from? And they overpaid for the quality and didn't have enough growth left. So getting those two bits together, quality growth, is about where I kind of forced to put myself in a box. That's probably where I do it.
So it's really about looking for, is there a good underlying product or business here, and does it have an opportunity to go and extend that into new markets or new opportunities or into new segments? That's essentially what you're trying to do.
Correct, or even same market, but just earlier stages. So one early stock was Premier Investments, which is Just Jeans, JJ, Smiggle, Peter Alexander. It has been a fantastic business because particularly that Smiggle and Peter Alexander businesses were new. You could see that people loved it. They had super pricing power. If you can force a tween to pay, or tween's mum to pay $25 for a pencil case, you're in a good place, right? Peter Alexander pajamas, right? Pajamas up the flannelette, things you and I would have bought from Best and Less. They are the $100, satin, God knows what. Those are really, when you have those insights and they're early in their development, that's a really, really powerful thing. So quality and growth together. Growth can be, as I say, new markets, new geographies, new verticals when it comes, pushing the brand sideways, for example, or literally just, hey, they are 25% along this path. I can see where that could go, and there's the growth opportunity ahead.
I mean, I can talk to Smiggle. I think there's like 25, things sitting in, like from bottles to pencil cases. My kids are like, they lose them all the time. I just got to buy another one. It's like, insane. No, you're right on it. What I find really interesting is that it actually just seems so logical, right? And so, but where have things gone unstuck for you? You talked about Coca-Cola Amateur, but on a growth thing, you're sort of making a thesis as to where this company can go next. You're taking a little bit of a punt as to what they could actually do. How do you put that together?
It's funny, and again, why I'm a kind of an everything investor. I'm not, I'm not an ideologue. Investors tend to be, whether it's value growth or something else. Yeah. There's a whole school of thought that says gambling and investing are different things. And they kind of are at the extremes, again, if you're looking at a continuum. Yeah. The reality is, in investing, you're doing the same as gambling, and this will make some people rich as they listen to me say it. You're working at the odds, right? You're saying there is no certainties in investing. What you've got to do is try and find the right, how many attributes can you put in the pro column, and how much are you paying for that benefit? And then will that play out over time? Now, that can be the business opportunity, it can be the price you're paying, it could be both. But there's always that combination between what am I getting, how much am I paying for it, and what is the likelihood of success or failure? And that's the simple reality is, and this is where if our members occasionally frustrate me, it's because they expect every pick to do well. Yeah. And I will say to them blue in the face, we will get 2, 3, 4 out of 10 wrong. Now, wrong doesn't mean losing all our money, but it means not doing as well as we thought. But if the 6 or 7 we get right do well, they'll more than pay for the losses. And that's kind of the idea. You're doing a portfolio approach, even if it's not a physical portfolio. You're saying this style of investing will be right more than it's wrong. And when it's right, we'll gain more than we lose. Mm-hmm. And the combination of those two together, so more winners than losers, and losers making more than the losers lose, means you're going to make money and beat the market. And that's been our experience thus far. The losers don't invalidate the strategy. It's almost the exception that proves the rule, right? Yeah. So that's kind of the approach.
In a way. If every stock was a winner, then no one would ever sell.
Well, and it wouldn't happen. Right? You'd never get that pricing. It'd never be possible. So that's always got to be the case. I have a really, really, really high tolerance for volatility and for being air quotes wrong, right? And you've got to be as an investor. So I've got a 5-year time horizon. Here's the thing: if you buy a stock, you're saying outright, implicitly or explicitly, I think the market is wrong. Because if the market's right, the shares can't be market beating because they're already priced well. You're by definition buying something cheaper than you think it's worth. Now, whether that's value investing or whether that's growth investing, either way, you're saying this business is worth more in 5 years than it is today. The thing is, the market doesn't realize you just bought it. It's all of a sudden going to change its tune. So if it thinks that company X is worth $2 a share and you think it's worth $3, expecting the market to change its mind just because you own the stock is crazy. Yeah. So you've got to wait for that to play out, right? You literally have to wait for it to play out. Even those that grow consistently, and Amazon's a great example. I own Amazon shares for full disclosure. Even as that grows, is it worth more every day? Yes. But it should have been worth the current price 5 years ago because if the future was going to be the future, right? It's that kind of, that's the way the maths should work. So at any point, even if the market's not disagreeing by the share price falling, if you get growth in the future, it's because the market's catching up to what you see. But you've got to realize that you're going to be perceived as wrong by the market because otherwise the shares will already be too expensive.
Absolutely. Yeah, they'd be where you think they'd be.
Exactly.
And then you'll be able to buy it at a value. Yeah. And in terms of, obviously, we're in lockdown, I guess, we're starting to obviously see different things in different parts of the world, which is great. The opportunity, did you see an opportunity when the market fell, or was there just too much rationality? How did you perceive it as an experienced investor?
So I've been banging the drum hugely, Matt, on trying to get people to invest. Yeah. The story here is a very, very simple one. And here's the I think people overcomplicate investing, right? It's not that, it's not easy, but it's simple, if that makes sense. Simple to think about, hard to do. Here's the simple reality. Throughout history, for more than a century, the market has never failed to regain a previous high. Okay? So let's take that. That's Exhibit A.
Yep.
Exhibit B, the market's fallen, or had fallen at its worst point, about 38% from that previous high. And if you do the maths backwards, that's a 50% gain, more than that, to get back to that high when it comes. Now, maybe it never comes. Maybe this is the exception that proves the rule. Maybe the market never regains 7,100 points. I think that's incredibly, incredibly unlikely. So if you're an investor and you're saying, hang on, A, I think the market will regain its previous high at some point, and B, it's 50% below that, or a third below that, but as it goes back up, because the denominator is smaller, you get 50% gain.
65 and back up, whatever, yeah.
You know it, right? So you kind of go, well, explain to me exactly why you wouldn't want to buy right now. And most people who didn't will say, oh, it might fall further. Yeah, it might. I don't know. I get one of the great things about working for the Motley Fool. I get to say I don't know a lot when I don't know. Other people have to make up answers, right? They have to show they're smart and capable and thoughtful, and they have all the answers. They're the masters of the universe. I don't know how long it takes. I don't know if the shares go lower in the meantime. It doesn't matter. It's like if you're offered a 50% gain, you say, no, I'm not going to take it in case I get a 60% offer. Yeah, maybe you do. Maybe you don't. Maybe it never gets that low again.
Yeah.
It drives me bananas. I think I get the human instinct to want to get the lowest possible price. We all do. Of course we do. But man, when you're being offered 50% upside, you're really going to say, no, I won't take it just in case I get more. It blows my mind. Yeah. Absolutely blows my mind. So I bet on yes, coronavirus is terrible. Yes, it will do awful things to the economy. Some companies will outright fail. Others will be diluted enormously with capital raisings. They're all true. But to believe the index won't get back to a decent level at some point, it's money. Again, I could be wrong, so I want to be really, really, really clear. Yeah. As an advisor, as a licensed financial advisor, I can't give guarantees because no one can and no one should. Yeah. But man, if this is the first time it doesn't get back to that previous high, well, then I guess so be it. But
it's like you're playing
not investing at these sort of prices, madness.
Yeah, no, it's a really very clear way to look at it. It's like I'm buying it. I know it's going to get there at some point. Well, here's an opportunity to get that discount. That's the way you're looking at it.
Kind of right.
Yeah.
And these are people, by the way, that were buying shares at 7,000 points on the way to 7,100. And that's fine. I'm not saying they shouldn't have done it. What I'm saying is, if you're going to buy them then, why are you not buying them now? It blows my mind.
Well, that's the rational approach, right? Like when you see the market and you see the news and the fear is out there, the worst is yet to come. It's hard to pull the trigger.
Yes. So, and again, that's a good point. I mean, I don't blame people for feeling that way either, right? So when I say it's a no-brainer, what I mean is through 20 plus years of experience, a lot of it hard won through I wasn't investing during the 87 crash, but I remember it. I was investing during the dot-com crash. I was investing during the GFC. I've been through heaps of volatility, right? So it's partly just I'm fortunate enough to be able to look back and say, I've been there, I've done that, I know how this movie ends. I don't blame anyone for feeling fearful or worried, or maybe this time it's different because ... If I had $1 for every time someone had told me over the last 22 years that this time is different because of X, it's like, okay, guys, of course it is. Yeah, you're very smart, you're very capable, and thank you very much. And again, I get it. I get the fear. I get the concern. But it's just you got to boil it down to its very simplest components, which is why would it be different this time over the long term? And if you're buying at 6,000, 6,500, 7,000 points, you're now being offered 5,000 points. Explain to me why you're not buying, and I don't think there's a good rational answer. There's plenty of rationalization, heaps of emotion, and again, I don't blame anyone for feeling that way. But when you really strip it back, I think the answer is there's an opportunity there to make something like a 50-ish% gain. And by the way, it's not going to stop at that high. It's probably going to go higher again. So I'm not even saying that's the maximum. What I'm saying is just get back to where you were at 50%. If it goes 10, 20, 30% higher again than that, well, guess what? You're in clover.
It's very wise words, and you simplify it nicely. I think a lot of people, you can read the news, you can get so caught up in the noise, but sometimes you hear just the pure numbers, and this is the way to play it. And when it's simplified, it makes it easy to execute. And you've got so many other factors, you're trying to weigh everything out. So, no, very, very good. And in terms of, obviously, you've got a really big following, and the Motley Fool's done amazingly well. Obviously, in Australia, obviously got a really big office and very successful business in the US as well, and over in the UK. What are the themes you're seeing from the research? Are they looking at companies that have just been sold down too hard, that are value based? Are they saying, actually, there are certain companies that have come out really strong from this? So what's the general take from the advice you guys are giving customers, if you can say?
It's a fascinating one, So there's a lot of, most of what we're trying to do is cut through the narratives, the fake narratives, right, or the false narratives, trying to work out what's consistent, what's changed. So it is kind of what I said before, but in a more nuanced way, is looking for those businesses that have been sold down unnecessarily or in terms of overreactions, right? If I see a business that otherwise is going to be fine, sold down because everything else has been sold down, there's the opportunity. We're also being really, really careful at the moment, though, about the survival reality. So as much as I'm super positive on investing in stocks at an index level, there are some businesses that, Webjet has had its share count double, right? So to get back to the previous share price, it's going to do even more, it's going to go do twice as well to get back to the previous price per share, because there's now twice as many shares on offer. So there's those sort of businesses. There are companies that, frankly, we've been talking about the banks a lot. I think the banks are a real concern. I don't know that they're going to go broke, but the returns are not going to be great. So that's a concern. I will say, you guys do, focus on the US. The US opportunities remain super strong. I think if you want to look through, we've seen only recently the Google's, Facebook's, Microsoft's, Tesla's report. I own Google shares for the record, and Amazon, as I mentioned before. As you see that come out, the opportunities there are still huge. The currency is not as positive as it once was. At $1.10, sending money to the US was a no-brainer. At 65 cents,
it's a little bit tougher.
Less obviously so. But if you believe in the long-term growth of these businesses, and I think that's, I use the line a lot, and it sounds like a marketing line, which makes me uncomfortable just intently.
Yeah, that's fine.
These companies are inventing the future. Like literally, this is not a book blurb. This is not a marketing line. Think about the changes that are being made. The Apples, the Googles, the Amazons, the Facebooks, the Netflixes, the MongoDBs, the Teslas. Like entirely new, form of transport. Effectively, still four wheels and a steering wheel, but not much more than that in terms of similarities with combustion engines. So that's where the future is being made. I think Australian businesses will keep doing well. Don't get me wrong. But if you think about the Australian market being dominated somewhere around 40-ish, 45%, used to be 50 before prices fell.
With the banks.
Banks and miners, right? Like, I don't think you want to be that exposed to those industries anyway. Even if this was the only option, I'd say, well, upweight some of the other industries. But then you look and say, well, where's banks and miners going to be growing at, double-digit percentages year after year after year after year? Very much doubt it. Are Amazon, Google, Facebook, Netflix, Tesla, et cetera, going to get around? I'm a Berkshire Hathaway shareholder. I mentioned Warren Buffett before. These are the best businesses on the planet. So, thematically, from an Australian perspective, I don't think people should be selling their ASX stocks and buying everything 65 cents US now in the US. But I think dollar cost averaging into your entire portfolio is really important. But into the US in particular is a great way to make sure you are really diversifying your portfolio on currency, industry, geography grounds, getting just some of the best businesses on the planet. I said I own in the US, I only own a few businesses, but it's Google, Amazon, Berkshire Hathaway. These are the companies that are the best in the business. And so just sheer quality alone, that remains big. And then there's the trends that are coming out of this. I think online commerce is going to get a kick.
Absolutely. So you're seeing it already.
Right. Woolies was out as we're recording, so I'm not sure how far away this goes to air. So if I'm giving away some dates and times, my apologies. But Woolies was out today with its sales. Coles was out with its sales the other day. We're talking about 11, 13% growth because of obviously panic buying. But the online growth, Woolies online sales up 34%.
Wow, amazing.
That's Woolies, right? So again, of course, it's pandemic, but there are people who are going to shop more online as a result. People who are going to shop online for the first time or for the second or third time as a result.
And now they're inducted.
Right, and that's exactly what it is, right? So those things will keep happening. Now, we should be a little bit careful. I think, again, let me go back to ancient history. 1987, when the crash happened, everyone said, that's the end of conspicuous consumption. Now, you're only going to look at many Teslas, Lamborghinis, Bentleys, Apple iPhones, the consumer product as status symbol hasn't waned at all.
That won't change. So
there are some trends that we had this big event, that it was the 87 crash. Now it's the coronavirus. We're all going to do this now. be a little bit careful with that, right? Don't jump at every narrative that we get sold on that one, because bosses aren't going to all of a sudden want people to work from home when they really want to be looking over their shoulders. And I'm very fortunate the Phil's not one of those businesses, but plenty of companies are, looking over the shoulder saying, are you at your desk? Are you doing what you're supposed to be doing? They'll want people back in the office real fast. Even though we all like working from home. Now, will that change? Yes, on the margins. And maybe I'm wrong. Maybe it changes hugely, but just be a little bit careful that we don't extrapolate those maybe wishful thinking kind of short-term issues. Some will become long-term trends. Others will die back. Maybe they come again at some other point. But don't buy the entire narrative. Make sure you test them to make sure they're going to last when business gets back to normal.
Yeah, unless you've got that experience, it's hard to see beyond what you see now, in a way, and that takes it's a skill in itself. So
exactly.
Amazing. No, it's amazing insights. I just wanted to. Sorry, one sec. Jonah Bug. My son's walked in. He wants to say hello. He loves the big guest. Jonah, come say hello.
Go for it.
Come on. He's a legend. You love him. So he's even dressed in his school uniform. Jonah, you do this every time I got someone on. It's great.
That's all right.
To show my pride and joy off. That's the bathroom. There you go. Sorry, this is. it's real in this house. We'll edit that out. But I just wanted to wrap it up and just obviously you taught a lot about your experience. Like, what would you say to investors right now? Like, what's the one thing you'd leave them with? If they're starting their investment journey or they're a few years in and it's been a pretty tough time for them. Like, what's your message?
A very, very simple message is that compound returns work, investing works. Now, people say, of course you say that you're a shares guy. You know what? I don't. I'm a shares guy because I believe compound investing works. That's actually the key point. Now, we know. Do yourselves a favor. Right? Google Vanguard Index Chart 2019. It will show you Australian shares, US shares over 30 years. And that 30 years includes the GFC. It includes the dot-com crash. It includes the Asian financial crisis. It includes Brexit. It includes Grexit. All that stuff is already in those numbers. And yet the returns, compound returns, are phenomenal. Yeah. So I get the fear. I get the concern. I get the what ifs. I get the headline shock. I get the just continued, kind of ceaseless hammering of headlines. Got to look at the long. Just grab that chart. Every time you feel worried, look back at that chart and see what 10 grand has done over 30 years. Yeah. And that's it. Honestly, it's that simple. I mean, I don't mean to seem blasé about it, but if you can show me something better than that, then knock yourself out. But yeah, and again, that's why I'm not saying invest everything today, sell the house and put it in shares. What I'm saying is dollar cost average every month or every quarter if you need to into shares, just month in, month out, quarter in, quarter out over the rest of your life. Again, no guarantees, but man, if you don't end up with a really large amount of money at the end of that process, you're doing something really badly wrong. It's
easier than turning up to the office and working 9 to 5 and smashing it out that way. Yeah. No, amazing, exactly. Scott. Well, thank you. I mean, a lot of our viewers would also want to know where they can follow you, and obviously phil.com.au is the website, but you've got, you're on Twitter. I know you're quite active there, and you're on radio as well, right? Yeah.
Oh, look, I'm pretty fortunate. We've there's a look. As I said, I'm a simple man, mate. You say I keep things simple. It helps if you're simple to start with. So we're pretty fortunate. There's a demand out there for kind of just giving it straight. So on Twitter and Instagram at TMF Scott P. For those who want to follow me there, I'm on Facebook at Scott Phillips Money. We do a podcast called Motley Full Money with Triple M. I've been on the 9 News doing the coronavirus stuff, doing the finance late news. So if you saw up at 11 o'clock at night, you'll see me there as well. But yeah, look, it's just one of the great things about the company I work for is I get to do stuff that isn't directly revenue generating. I don't mean that as in they're blasé about it, but there's value in brand, there's value in helping people actually just do better. And so we get a lot of license to go and do things that simply help us help other people. The podcast's free. We do a couple of hours worth of podcasting a week. Hopefully we get some members out of it, some subscribers out of it, but it's also just helping some people, get a better rate on their home loan or just invest a little bit better. We get to do that, and that's one of the great things about working for a company that actually does care. Yes, of course we're for profit. Of course we want to make some money, but also just does care about helping people become better investors. No, I mean, your story layers up into that, in terms of where you started. There's 2 things I took from it. One is your absolute passion for investing. So it's just, it's like, that's amazing. It's just like, it's inspiring. And the other thing is I'm not believing the introvert comment whatsoever when you reeled off all the places that you are. I am very happy to put you in touch with my wife. My wife will guarantee, she will cry down the phone and guarantee that I'm an introvert. I like nothing better than staying in the house, and she loves nothing better than going out.
Well, I think you use it up too much outside of work, so maybe pass that one on. No, I just want to say a massive thank you, and that was, super insightful, and it's always amazing to have great guests here. So appreciate your time.
I appreciate the invitation. Thanks, man.
Thanks, Scott. I'll just stop recording.